As the impact of the Omicron variant receded in January of this year, more countries relaxed travel restrictions and bookings started to steadily improve again. Relative to 2019, the second quarter of 2022 actually showed the strongest sequential quarterly bookings improvement since the pandemic recovery started in June of 2020. Corporate and international travel accelerated nicely during the quarter, driving our distribution revenue per booking higher. Hotel CRS transactions continued to lead the recovery, and in the second quarter of 2022 were 102% compared to the same period in 2019. IT solutions passengers boarded recovered 89% in the second quarter versus the same period in 2019. The total distribution bookings recovery was 57%, which equates to a 63% revenue recovery as a result of the higher booking rate achieved in the second quarter of 2022 versus that same period in 2019. The sequential quarterly recovery versus 2019 was greater than 10 percentage points in every region in the second quarter. APAC continues to be the slowest to recover, and Latin America the most recovered. Excluding the impact of Expedia, our recovery was in line with or better than broader GDS industry recovery. Late in Q2 and into July, we've seen the rate of recovery moderate. Globally, we believe the desire to travel continues to be very strong. In fact, consumer demand is so great that in a number of countries, particularly in Europe, travel demand currently outpaces the ability of airlines and airports to efficiently handle the passenger volume due to staffing shortage and other factors. This has caused delays, cancellations, lost bags, and lower customer satisfaction, which we believe has constrained near-term net new bookings as passengers seek to avoid these issues. We believe that in response to these operational challenges, airlines have reduced their schedules in some countries. They are still flying more seats than they were earlier in the COVID pandemic recovery, but capacity constraints have limited their ability to fully match customer demand. Consequently, airline seat capacity is currently below demand, which has driven airfares up significantly. For example, yield or passenger price per mile was up about 33% year over year in the second quarter of 2022 for the three largest U.S. full-service airlines, American, Delta, and United. So we believe we are temporarily in a capacity-constrained period with higher than normal fares, but importantly, also with consumers eager to fly despite these challenges. The good news for travelers and for Sabre is that airlines and airports are working aggressively to improve their operational throughput and have significant financial incentives to do so. Many airlines have been aggressively hiring and training not just pilots, but also other in-flight personnel and airport operations staff to provide operational flexibility. This hiring has driven airlines' unit costs sharply higher, and they want to increase aircraft utilization and seat capacity to help spread their costs. For example, several large U.S. airlines suggested on their second quarter earnings call that they expect 2023 capacity to be up more than 15 percentage points from the current levels. As we look forward to the balance of 2022, we are optimistic for a few different reasons. First, over the last 18 months, we have seen a strong correlation between hospitality and distribution booking curves, with hospitality as a forward indicator of improvement. On this chart, you can see the improving hospitality trends. Even though it is less COVID-related than prior months, the correlation is still evident. Second, forward air bookings for travel in August, and more specifically September and October, are tracking similar to that experienced in stronger recovery months. If these trends continue, we would assume that passengers are currently looking beyond the near-term operational issues and that any recessionary pressure has not yet impacted future travel. As we've discussed before, international bookings are generally more profitable than domestic bookings for Sabre. Consequently, as international flying returns more fully, we expect our profitability to improve. In Asia Pacific, international bookings have only recovered to about 40% of the 2019 levels. The willingness to fly in that region is strong, as evidenced by the domestic recovery, but currently travel restrictions greatly curtail APAC international flying. We estimate that if APAC were to recover to the average of other regions, it would increase our annualized revenues by more than $100 million.
Today we increased our 2022 revenue and adjusted EBITDA outlook for each of the booking recovery scenarios. Specifically, we expect adjusted EBITDA to exceed our prior expectation by at least $85 million under each of the booking recovery scenarios. The improvement in our forecast includes better than expected second quarter adjusted EBITDA of $24 million, which was driven in part by stronger than anticipated revenue per booking as our business mix improved. In addition, we expect to add incremental bookings in the back half of the year from recent new customer contracts. Given recent concerns regarding a possible economic slowdown, we thought it would be useful to provide perspective for how COVID impacted global air travel in 2020 to 2022, and to compare that to how recessions have historically reduced travel. As you can see from the table on the right side of this slide, global airline passengers tend to grow at a multiple of GDP, and air travel also tends to be economically resilient. In past economic downturns, the largest calendar year drop in global passengers was only about 3%. Typically, when a recession occurs, airlines reduce fares and find price-elastic passengers willing to travel at a discount. The COVID pandemic's effect on air travel was completely different. For perhaps the first time in modern aviation history, due to global travel restrictions, there were essentially no customers able to take advantage of lower airfares. Airlines resorted to slashing capacity, reducing staff, raising capital, and waiting for travel lanes to reopen. As the COVID crisis has receded, we are seeing airlines reverse these decisions. They are adding capacity, staffing back up, and preparing for more normal times. We estimate about 1.5 billion fewer airline passengers will fly in 2022 than would have had the COVID pandemic not happened. This admittedly rough estimate represents the gap between how many global passengers we estimate will actually fly this year and the number of global passengers in 2019 grown at just 2.5% each year to 2022. As we have highlighted many times, our technology transformation, which includes mainframe offload and migration to Google Cloud, is a key driver of expected savings and margin improvement by 2025. Additionally, our technology transformation is expected to unlock many product enhancement opportunities while significantly increasing our productivity, flexibility, and speed to market, which we believe will resonate with our customers. I'm pleased with the progress we have made in the second quarter toward our 2022 technology milestones, and our tech transformation remains on track to achieve stated goals by the end of 2024. As a reminder, our two key technology milestones for 2022 are to exit our Sabre managed data centers and migrate to Google Cloud, and to offload Passenger Name Record, a customer reservations database, from the mainframe to Google Cloud, and to begin client migrations.
Thank you. And our next question is from the line of Josh Baer with Morgan Stanley. Your line is now open.
Great, thanks for the question, and good to see the improving business mix have an impact throughout the results. Question is a macro question and sort of that exercise looking at past downturns as a roadmap for potential demand and resiliency looking forward. And it's on the corporate side. And just how are you thinking about some of the differences in today's world, the kind of ubiquity of Zoom and digital alternatives to business meetings and conferences that didn't exist in past downturns when you're thinking about the recovery on the corporate side?
So Josh, let me kick off, and then I'm going to pass it over to Kurt because I think he can provide some insight just based on his previous experience. So if we look at corporate recovery right now, it has closed the gap significantly with what we have been seeing on the leisure side. So, with that, we're very pleased. And I think this is a lot stronger than people had actually anticipated. I know if we go back a couple of quarters, people were questioning us relative to how quickly, corporate would recover, and we're definitely seeing that. I think where Kurt can pick up is what we're seeing and hearing as it relates to business mix. It may not be the same that people are traveling to see, but when you think about what's happening within companies, and I can speak about Sabre specifically, we have a lot of internal travel taking place, even though we're in a work from anywhere environment. So Kurt, I'll pass it over to you.
Yeah, thank you. There was clearly a lot of conjecture during COVID about whether there would be long-term structural impairment resulting from newer technologies, et cetera. We've seen, as Sean indicated, a much stronger rebound in corporate travel in 2022 than most people anticipated. There may be some dampening of travel to see customers, although that's been more robust than we expected. And with the fundamental shift to work from anywhere, there's going to be a lot more internal corporate travel than there was previously. We had, in the 2025 guidance we issued earlier this year, we indicated an assumption of 90% corporate recovery by that point in time. I can tell you I'm much more bullish about where corporate will be at that point in time than I was 6 months ago. And I think that as you speak to TMCs and corporate travel managers, they would echo that.
Thank you. And our next question is from the line of Jed Kelly with Oppenheimer. Your line is open.
Just circling back on the corporate travel recovery, can you kind of talk about how we should think about that impacting your margins in the back half and into 23?
Yeah, so we've talked about before, and I think this was in Doug's remarks, that our revenue per booking increases with a shift toward long haul and corporate recovery. We had previously, in prior calls, provided guidance that as compared to 2019 and excluding Expedia, you should expect to see our revenue per booking increase by 10 to 15% to a range of $5.30 to $5.50. So we do expect to see upside in the second half of the year as our GDS or distribution mix continues to improve with the recovery in long haul international and also corporate. So we think there is upside there.
Just with the stronger dollar, in terms of the potential for more Americans to maybe want to travel abroad because, obviously stronger dollar benefits them. Do you see a benefit from that? Like, how does that impact you volume-wise? Thanks.
Well, obviously, if more Americans want to travel, that's how they benefit us. Just remember that the vast majority of our revenues are already in dollars. So there's no FX impact from the strong dollar.
But from a booking perspective, Jed, just going back, I think a lot of us have been traveling, throughout Europe and other places. There's a lot of U.S. citizens that are traveling abroad, and we expect that to continue.